Employee benefits represent an important area of financial reporting because they involve significant obligations and expenses that directly affect an entity's profitability, financial position, and workforce management. Under IFRS accounting standards, employee benefits are governed primarily by IAS 19 Employee Benefits, which establishes principles for recognizing, measuring, and disclosing obligations arising from services provided by employees. Employee benefits include all forms of consideration given in exchange for employee services, such as salaries, pensions, bonuses, leave entitlements, and termination payments. The DipFRS syllabus emphasizes the importance of understanding different categories of employee benefits because each type requires distinct accounting treatment. Proper accounting ensures transparency, comparability, and faithful representation of obligations owed to employees within international financial reporting environments. Short-term employee benefits are benefits expected to be settled wholly within 12 months after the reporting period in which employees provide related services. Examples include wages, salaries, paid annual leave, bonuses, profit-sharing arrangements, and non-monetary benefits such as medical care or company vehicles. These benefits are generally straightforward to account for because measurement uncertainty is limited and settlement occurs quickly. IAS 19 requires employers to recognize short-term employee benefit expenses as employees render services and recognize corresponding liabilities for unpaid amounts. Undiscounted amounts are typically used because the time value of money is usually immaterial over short periods. This treatment ensures accurate matching between employee services received and expenses recognized within the relevant reporting period. Long-term employee benefits differ from short-term benefits because settlement occurs more than 12 months after the reporting period. Examples include long service leave, deferred compensation arrangements, jubilee benefits, and long-term disability benefits. These obligations often involve greater uncertainty regarding timing, employee retention, inflation, and future salary increases. Consequently, long-term employee benefits require actuarial valuation techniques and discounting to present value using appropriate discount rates. Unlike short-term benefits, gains and losses from remeasurements of long-term employee benefits are generally recognized immediately in profit or loss rather than deferred. Proper accounting for long-term benefits ensures that obligations are measured realistically and that financial statements accurately reflect the economic cost of employee service commitments extending into future reporting periods. Termination benefits arise when an entity decides to terminate employment before normal retirement dates or offers incentives for employees to leave voluntarily. These benefits may include severance payments, compensation packages, or early retirement incentives. IAS 19 requires recognition of termination benefits when the entity can no longer withdraw the offer or when restructuring costs involving termination benefits are recognized under IAS 37. Measurement depends on the nature and timing of settlement, with long-term termination obligations discounted where material. Recognition of termination benefits often occurs before cash settlement because obligations arise from formal commitments made to employees. Accurate accounting is important because termination programs can involve substantial costs that significantly affect profitability, restructuring activities, and financial statement disclosures during periods of organizational change. Defined contribution plans are retirement benefit arrangements where employers make fixed contributions into separate funds without assuming responsibility for future benefit levels. Examples include pension schemes where employer obligations are limited to specified contributions. Under IAS 19, accounting for defined contribution plans is relatively simple because employers recognize contributions as expenses when employees provide services. Any unpaid contributions are recognized as liabilities at reporting dates. Investment risk and actuarial risk are borne by employees rather than employers. Because future obligations depend solely on contributions made, no actuarial valuations or complex estimates are required. This accounting approach provides clarity and simplicity while ensuring that financial statements reflect employer obligations accurately without recognizing uncertain long-term pension liabilities. Defined benefit plans are significantly more complex because employers promise specified retirement benefits based on factors such as salary levels, years of service, and retirement age. Under these plans, employers bear actuarial and investment risks because future benefit obligations may exceed plan assets. IAS 19 requires employers to recognize the net defined benefit liability or asset, calculated as the present value of defined benefit obligations less the fair value of plan assets. Measurement requires actuarial assumptions relating to employee turnover, mortality, salary growth, inflation, and discount rates. Current service cost, interest cost, and remeasurement gains or losses are recognized separately within financial statements. This approach ensures comprehensive recognition of pension obligations and improves transparency regarding long-term employee benefit commitments. Accounting for defined benefit plans involves several important components affecting both profit or loss and other comprehensive income. Current service costs and net interest expenses are recognized within profit or loss because they relate directly to employee service and financing effects. However, actuarial gains and losses arising from changes in assumptions or experience adjustments are recognized in other comprehensive income and are not subsequently recycled through profit or loss. Plan assets are measured at fair value, and entities must disclose detailed information regarding risks, assumptions, funding policies, and sensitivity analyses. These disclosures help investors and stakeholders evaluate the uncertainty and long-term financial impact associated with pension obligations. Proper accounting therefore strengthens transparency and comparability within international financial reporting environments. Overall, IAS 19 provides a comprehensive framework for recognizing, measuring, and disclosing employee benefits in financial statements. By distinguishing between short-term benefits, long-term benefits, termination benefits, defined contribution plans, and defined benefit plans, the standard ensures that obligations are accounted for according to their economic substance and risk characteristics. Accurate accounting for employee benefits is essential because workforce-related obligations often represent substantial liabilities and significantly influence profitability, liquidity, and financial position. The DipFRS syllabus emphasizes that understanding employee benefit accounting requires both technical knowledge and professional judgment, particularly in areas involving actuarial assumptions and long-term obligations. Proper application of IAS 19 enhances transparency, supports informed decision-making, and promotes confidence in international financial reporting practices.